Today, I want to discuss one thing. Is the US stock market in a bubble? Okay. Now, this is something I think it's very important to have a clear idea about it. Now, valuations are high. You've heard it from the Fed officials, Wall Street CEOs, and every other YouTube thumbnail. They're not wrong about the level of valuations, but bubble is a strong word. The truth is more complicated. Some pockets of market looks frothy. That means they are not stable. They're already right there at the top already, and they can be like pushing the limit. Okay. Others look fairly valued, and a few still look neglected and cheap. Now, the key question is whether prices are outrunning the cash flows that ultimately justifies them. So first of all, let's look into this particular point. What makes a real bubble? Now, a true bubble is price detached from profits. That was the hallmark of the late 90s, when many winners had little or no earnings. So if you have started investing or trading just before the dot-com bubble, you will understand this particular thing that I'm talking about right now. Now, today's market leaders, are different in an important way. The biggest drivers of the indices are producing strong revenues growth and hefty free cash flow. So when price rises with profits, expensive does not automatically mean bubble, though future returns can be lower from a high starting point. Yes, you're buying things at a high starting point, so how far can this thing still go? Okay, you might not make as much as buying it from a lower value, right? So what the big valuation gauges are saying? Now, index level gauges do flash yellow. The S&P 500 trades around 21 times forward earnings, above its 10-year average near 18 times, elevated but not off the charts. And long-term Shiller Cape just ticked 39 to 40, the highest since the dot-com peak, and historically consistent with lower long-run returns from today's starting point. That's the clearest yellow light. Now take note that the dot-com 2000 peak was 44. Cape, however, is a poor timing tops, but it does flag expensive times that we are going through right now. Now, Fed Chair Jerome Powell has said equities look highly valued, and Governor Lisa Cook noted elevated valuations pressures. Okay, that's what she is also seeing as well. Now, the translation is very simple. The Fed, right, sees froth, sees there's some degree of struggling, even if it isn't calling the whole market a bubble. So whether that premium is justified depends on earnings growth and margin durability. On both counts, the broad profit picture has held up better than feared. Okay? So earnings margins and the year 2000 comparisons. Now, a fairer way to talk value is price relative to growth. When profits and cash flows rise with price, multiples can look high yet be defensible. That's a key way to differs from 2000. Profits at the biggest drivers are robust, and S&P 500 margins are near record highs even outside pure tech. Okay, so what's the problem right now that people are seeing, that the Feds are worried about? The most bubble zone prone zones share two traits right over here. A powerful story, lift prices while profit lags. Now, this is a big problem. That mix attracts fast money and makes drawdown brutal when the narrative cools. So one sector dominates this narrative at the moment: unprofitable AI and frontier computing. Now, companies adopting AI or frontier computing often jump after news about partnerships, flashy demos, and big promise about how huge the market could be, but they still depend they still spend more money than they bring in. Now, sales can grow, yet costs stay high, so business does not produce extra cash. They also pay employees with lots of company shares and sell even more new shares to raise money, which makes each existing investor's life smaller. So in short, prices are being lifted more by a good story than by steady proven profits. Not all AI is alike, okay? Cash generating infrastructure leaders sit outside this bucket. Now, the bubble-prone group are the frontier platforms that promise future profits, but lack durable cash generation today. They can trend higher on momentum, which makes them tradable, but they are fragile as investments. So what you do is that you run a simple upgrade test, before you look into these companies. Now, one of these simple tests is 4 or more quarters of positive free cash flow, operating and gross margin improving without rising consumer or customer acquisition costs, net revenue retention comfortably above 110% with fewer customers or less revenue are being lost over time, share dilution showing and balance sheet runway extending beyond 2 years so that cash can cover expected spending for at least 24 months at the current burn rate. So until these show up, treat trades as short flings. If you really want to, trade all these AIs based on the narrative and not proper fundamentals, not strong fundamentals, I would say. So keep position sizes small, use hard stops, avoid averaging down, and let price action rather than hope decide the exit. So where value still high, by contrast, several neglected groups still offer reasonable entry points. Now, healthcare provides steady cash flows and balance sheet strength at valuations closer to long-run norms. Select enterprise software names that gush cash but lack headline hype may have been marked down on blanket fears of disruption, even as many will use AI to widen moats. Core industrials and financial data franchises compound quietly and often trade at mid-teen multiples while throwing off durable free cash flow. Now, these are the parts of the market that crowd ignores when it chases the latest story, right? So these 3 areas, you can look into it. Now, other things to take note, when the Fed lowers rates in a maintenance style move while growth is still positive, past cycle often saw equities grind higher after an initial wobble. So rate cuts also reshuffle leadership. Bond holders usually benefits as yield drift down as older bonds is now worth more on the market. Real estate investment trust tends to gain from lower fund costing and falling cap rates. Housing-related businesses and parts of consumer discretionary often enjoy renewed demand as financing gets cheaper. None of these guarantee a straight lineup. Market moves in waves and pullbacks are normal even with stronger trends. Okay. So as a conclusion, so is the market in a bubble? At the index level, call it pricey with pockets of euphoria, not a blanket bubble. The danger lies in mistaking narratives for fundamentals. Focus on businesses where price is supported by profits. Treat story stocks as trades rather than spouses, and view pullbacks as chances to accumulate quality. You will not need to guess the exact top to come out ahead, yeah? You don't need to. That's just to sometimes just to feed the ego. Okay. So with that, that's the fundamental report for today.